The Johannesburg Stock Exchange is slightly changed in midday trade, with its global peers mixed as markets digest news of supply chain breakdowns, rising U.S. Treasury yields and the U.S. nearing its debt limit. Mr. Matete Thulare, who is the head of foreign exchange execution at Rand Merchant Bank, joins us now to talk through the latest business news. Good to have you with us once again on the Daytime Update. Now, the Rand is slightly firmer, but it does remain close to 5-week lows, while gold is near 7-week lows as yields continue to climb and inflation worries persist. Can you talk us through the sentiments that are driving those moves?
Good afternoon. For me, I think obviously as we've seen, the Rand has weakened for the third day, touching highs of 15.15, as investors, really looking to turn away from risky assets amid a cocktail of issues, to be honest, in these global markets. I think if you just look at it, we've got an energy crisis, there's rising treasury yields, and obviously there's concerns that are around Chinese growth. I mean, year to date, the Rand has lost about 2.5%, whilst over the last 3 months, we've lost about 5%. And I mean, if you just take into cognizance what's happened from a local front and from a global front over the past 3 months, I mean, it includes things like the local riots that we saw, and also it involves what's been happening from an offshore perspective with regards to what the Fed has been saying about them increasing interest rates, and also what's happening with regards to the default issues that the Chinese state-owned enterprise property company Evergrande is also filtering into the market. And on top of that, I mean, we have seen outflows in the local bond market extending for the past 13 days. But as I said earlier, the big story at the moment for us that's giving us a lot of focus is obviously the energy supply shortages out in Europe and in China. And this is obviously raising fears about the potential for similar issues in the US, and possibly a speculation that this could create a permanent upward impact on inflation. And as you said, I mean, even on the commodity front, on the back of that, we've even seen the likes of the oil price now rallying, touching $80 a barrel. And now the market is starting to preempt and potentially think that we could be seeing, $90 a barrel in the next few weeks. Whilst on the gold front, it's not looking as shiny as we've seen it. I mean, at some point or another, a few weeks ago, it was trading close to $2,000 an ounce, and obviously now it's pulled back to around 1,740 at this point in time, which obviously reflects, all the volatility in the market that we are seeing.
Now, S&P says that South Africa's gap with its pre-pandemic activity has narrowed faster than expected, though there is still some significant slack in the economy. What are some of these risks?
Look, and I think we really need to give a lot of impetus and cognizance to the fact that S&P is one of the 3 ratings agencies that will be releasing their ratings update in the latter part of the year. So they did come out with a statement yesterday to say, look, some of the main risks to the South African economy are obviously the low vaccination rates and further lockdowns that will be implemented to curb the spread of the coronavirus pandemic. I mean, the other thing that they did note, which obviously filters through from what happened last week out in the US, is the higher borrowing costs that are associated with tighter global financing conditions, and obviously the spillover effect of what I was speaking about earlier around the Chinese property sector with Evergrande, obviously weighing on demand for metals and also posing a risk to the outlook. I mean, already there is an impact on the copper price and the iron ore price and also the likes of rhodium. So that also filters through into the Chinese property market. But nonetheless, S&P did note that, the strict lockdown restrictions and also the deadly riots that we saw in July between KZN and Johannesburg will likely lead to an economic contraction in the third quarter of this year. And obviously, I mean, they have said that, just like how we have been seeing a lot of analysis that the central bank will leave interest rates where they are at these record low levels of 3.5 until the beginning of 2022. But I think, as we all know, that, the main concern right now is for the fact that we really need to get the vaccination programs up and running. And obviously, if we do get those running, that will continue to at least improve consumer and business confidence. And obviously, as a lot of people have been saying, trying to open the economy up and reopen and get, even the likes of the travel and tourism industry, which has suffered quite significantly from all of this, to actually start also getting into first gear.
Now, we've seen the Momentum Metropolitan Health Group announcing a triple BE deal that's set to bring in investment arms such as national education, NAHAWU, as well as the police and the prison civil rights union. Now, these are all prospective shareholders, or these are shareholders in the business. What do we know about the makeup of this deal and who really stands to benefit?
Quite an interesting announcement by the Metropolitan Momentum Health Group. I mean, obviously, they're announcing this triple BE deal that obviously involves the investment arms of the likes of NAHAWU and Pop Crew, as shareholders in the business. And I think if you just think back and you just take a step back, I mean, Momentum already provides medical insurance to around 3.2 million people, including individual consumers and employees in the groups, and also employees in the retail, corporate, and public sector. So they have said that, look, they are looking at revising their shareholding in the health division of the JSE-listed Momentum Group, which will see the likes of NAHAWU, Pop Crew, as well as a number of black business leaders in the healthcare sector take about a 32% stake in the business. And I mean, this is on the back of what we saw last week, where ABSA also has embarked on a triple BE deal that's worth around 9.4 billion rands. But also, Momentum has said that with this transaction taking place, they'll retain the remaining 68%. And then this brings together an exciting set of stakeholders who've got the very same positive intent and also the skill set required to solve for a better future for improving the healthcare industry, which is something that will be quite interesting to see how it pans out over the next few months. But as I said, I mean, the deal comes against the backdrop of increased pressure from government on financial institutions to actually transform in an effort to bring in more black people into mainstream economy, particularly at the ownership and management level. So I think between this specific transaction and also the one that was announced by ABSA last week, I think it's a step in the right direction.
As we wrap up our markets stories for today, now, according to the Bank Serve Africa Take-Home Pay Index, South Africa's nominal take-home pay increased by 8.1% year-on-year in August of 2021. Talk us through those findings as well as the dynamics that have influenced this.
So, look, I think Bank Serve's report was quite an interesting one because I suppose, that 8% increase, it's quite relative. But, I mean, what they have also noted is that although August is probably not the best month to compare the inflationary impact on salaries due to the overall pandemic that we have seen and obviously the rolling lockdown periods, it is interesting to see that the take-home pay levels in real terms in this year of August 2021 is slightly lower than August between 2016 and 2019. Salaries have stagnated as the take-home component has only kept up with inflation, I mean, over the past year, mainly due to a drop in the number of lower-paid employees. So that's where the real numbers now start, and as soon as you start dissecting it, it starts showing you that the cumulative total take-home pay paid in August this year was 1.4% lower in real terms. And this obviously reflects, consumer spending numbers such as retail sales, which aren't looking great. But also, the nominal increase in take-home pay was the highest since January 2020. So, however, I mean, in most months, we've seen significant increases in average salaries. That's because there has been a sizable decline in the number of lower-paid employees, as I stated earlier. But as I said, I mean, obviously, this also takes into account, the unemployment rate that we have seen over the past couple of months that is not really looking great. And I think that is also going to be something that the next survey will obviously reflect.
Mr. Matete Thulare, thank you very much for your insight this afternoon. He is Head of Foreign Exchange Execution at Rand Merchant Bank.